Welcome to episode number 194 of AAA Weekly Webinar Series. Last webinar was on preferential transactions, various transactions that we explained which are accepted by judicial pronouncements as preferential transactions, and various transactions which has not been accepted as preferential transactions. So that was a kind of a guide to all the insolvency professionals, lawyers, about complete understanding of Section 43, the preferential transactions. So today we have brought to you Section 45, also some Section 49 impact also. So that is the undervalued transactions. Although the Amendment Bill 2025 has changed the name of this undervalued transaction, we'll come to the amendments which are proposed in the Amendment Bill. But again, the focus would be to explain to you what exactly is Section 45, what kind of orders can be sought from the adjudicating authority, and what are the kind of transactions which are so far accepted by adjudicating authority as undervalued transactions, and what are the transactions which are not accepted by the adjudicating authority as undervalued transactions. So going by Section 45, first of all, we have to see what are undervalued transactions. So there is a first condition whenever we categorize a transaction under Section 45 as undervalued transaction. The very first condition is there should be a transfer. There should be a transfer of a property. There should be a transfer of a property. And that property transfer is must. If there is no property transfer, if there is no transfer of any asset of the corporate debtor to any other person, then Section 45 is not at all applicable. So this is something which is very important, that there has to be a transfer, and that transfer, now we will come to that, whether this transfer or a gift. Second is that it can also be a gift, although the private limited companies are not making any gift to any person, neither it is accepted. So therefore, we have not been able to find any transaction where it has been held that the corporate debtor has given a gift to a third party, and that kind of transactions have not been found. So therefore, the transactions that we have found is where one or more assets of the corporate debtor has been transferred to a third party, and if it is to transfer to a related party, then again a look back period of 2 years, and if it is transferred to a non-related party, then the look back period is 1 year. So the transactions has to be within the look back period for the purpose of getting a favorable order from the adjudicating authority. And this is something which is very important to understand, that this kind of section, in case the undervalued transaction is not reported by the RP or the liquidator, then in this section, the transaction can even be reported by any creditor. It can even be reported by any member of the company or any partner of the company. And in case RP or the liquidator fails to report, and creditor or the partner or the member reports that transaction, and finally that transaction is held as undervalued transaction, then certainly the RP or the liquidator will face disciplinary action from the regulator, that is IBPI. Also has undergone some changes as per the proposed amendment bill, and maybe that this Section 47 impact, that application can be made by a creditor, member, or a partner, that actually has come to other sections also. So in case the RP or the liquidator is not reporting these transactions to the adjudicating authority, then he is running a risk. He is actually working under a risk of disciplinary action in case any other party reports that transaction to the adjudicating authority. So when we say the any transfer of an asset, which involves transfer of one or more assets is the first condition. For a consideration, the value of which is significantly less than the value of the consideration provided by the corporate debtor, and such transaction has not been taken place in the ordinary course of business of the corporate debtor. Not many cases the respondents has said that this transaction has been taken up as an ordinary course of business, but most of the transactions are where the confusion of the categorization has actually worked in favor of the promoters or worked in favor of the beneficiary. So therefore, the RP or the liquidator must act in a firm manner, must categorize that this is a transaction under section 45, then only the adjudicating authority will give. See, we will come to various such judgments. However, there is a special section, which is section 46, subsection 2, which says that the adjudicating authority may require an independent expert to assess the value of the transaction. If the RP has found that this is the value of the actual transaction, the RP also supposed to find what should have been the actual value of the transaction. And since the RP is not a kind of expert in everything, so the RP or the liquidator must find out whether he has evidences that the actual value is higher, and that may be a valuation report, that may be any other documents which says that the actual value is much more than the value at which the transaction has actually taken place between the corporate debtor and that other party. So therefore, the valuation option should be exercised, and without valuation option, it would be very difficult to justify the gap between the actual value of the asset and the value at which the transaction have happened. So the various kind of orders that can be obtained, various kinds of order that can be obtained by the RP or the liquidator can ask and can pray for that the transaction should be held as void and it should be reversed. And the other option with the RP or the liquidator is require any property transferred as part of the transaction to be vested back to the corporate debtor. Similarly, there can be any interest created by the third parties, so that can also be kind of considered as the third party interests are released or discharged. There are some orders from NCLT where I feel those kind of orders, if they could have argued well, according to my understanding, those are undervalued transactions. But in some of the orders, it has actually been held as not accepted as undervalued transactions. So coming to the various transactions, I would say that there are few judgments on from Supreme Court where the not exactly on section 45, but the primarily structure of the avoidance transaction. Like for example, one of the judgment which is in the name of Piramal Capital versus 63 Moons Technologies that was given on 1st April 2025, the Supreme Court has in fact clarified that avoidance transactions and the provisions under IBC are meant to restore value to the insolvency estate and protect creditors' interest. Section 45 is not about form or intent, it is about whether the value was lost to the corporate debtor. When we see a transaction with this lens, then it can actually fall into section 45. So that kind of impression must be there that the value has been lost for the corporate debtor. See, in another judgment, which is the Phoenix ARC Private Limited versus Spade Financial Services, and that judgment was dated 1st of February 2021. in fact, the Honorable Supreme Court in fact laid down that the avoidance transaction provisions under IBC, including Section 45, require courts to look beyond the form of a transaction and examine its real economic substance. The court held that the transactions which appear commercial on paper but in effect result in depletion of the corporate debtor's asset base are liable to the scrutiny. That is what probably was the direction to the adjudicating authority. So in the case of Anuj Jain, the very popular judgment on the avoidance transactions, Anuj Jain, the IRP for the JP Infra Tech Limited versus Axis Bank Limited. This judgment was dated 26th of February 2020, where the Supreme Court has held that Section 45, there is a different argument, different structure, different kind of application. It is totally different from Section 43 and Section 66, so there should not be a common application. These transactions should be submitted to NCLT in a single separate transaction. And I also say mostly that in case there is a large value transaction that has actually been found by RP or the liquidator, there can be a separate application for large value, undervalued transactions, only to get a faster decision so that the same can be in fact factored in the value for the resolution plan acceptance or rejection. So therefore, I say that the large value transactions, even if it is for Section 43 or Section 45, that should be submitted to adjudicating authority separately so that there are limited number of respondents, there are limited number of replies or rejoinders required. So therefore, the judgment can be taken in a much faster manner, and that kind of order can actually become part of the resolution value. So this is again, like I would say, there are various transactions that actually, in fact, we have won some cases. One case that we have recently won from, in the case of Greenfield Overseas versus Anil Goel, that is me, in my capacity as liquidator of Loha Ispat. And the transactions, in fact, the transactions were, the company was having stocks and the creditors were outstanding in the books of account, and these were the old creditors. So what the company did, the company in fact gave the stock to the creditor, passed a voucher as if it is a sales return to the same person who supplied it. So the material was supplied long back, maybe 2 years before the material return. So it was basically a steel, so it was not perishable. However, the return was, the purchase return was shown at much lower value as compared to the original price. So then we challenged this transaction, and NCLT approved this transaction, and NCL 80 also approved this transaction. The only modification which NCL 80 in fact ordered was that there were few transactions which were actually falling outside the look-back period. So the NCL 80 said that you only restrict yourself to the transactions which are within the look-back period. So therefore, all those transactions which are within the look-back period, those were all upheld. Now the party has gone to Supreme Court, filed an appeal before the Supreme Court. But look, the creditor was already there, the old creditor. Stock is an asset of the company which was transferred to a creditor. The value at which the purchase return was shown, that was much lower than the original purchase price. It was a steel item, so it was not perishable. The item was not even specifically made for any customer. It was a commodity kind of item. So in fact, the price must have gone up. However, this transaction was shown as a purchase return. So this was rightly caught by us, and it was rightly ordered by the NCLT and NCL 80.
We have a judgment which is Ram Bhat Jain versus Tarun Batra. This is an NC LAT judgment, and this is dated 4th of April 24th. The principle emerging from this judgment is that a transaction qualifies as an undervalued transaction under section 45 of the IBC, where the corporate debtor transfers goods or asset for consideration slightly lower than their cost or market value outside the ordinary course of business during the relevant look-back period, resulting in demonstrable loss to the corporate estate irrespective of whether the transaction is structured as a sale, adjustment or book entry. So the argument here from the representative of the promoters was that the transaction that is questioned here under section 45 is actually a transaction which is in the ordinary course of business. Why? Because the transaction was structured as a sale, the transaction was structured as an adjustment with the debtors, with the creditors, and it was a book entry. So they were saying that this is ordinary course of business. But NCLT here and NCLAT also said that no, you can't do a transaction like this which allows the company to sell assets owned by the company or dispose assets owned by the company for a value which is lesser than their market value in the disguise of business operations. So you have to say that no, this is also important. So the corporate debtor here was Sri Vardhaman Rice Mills Private Limited, and they were having huge stocks. They were having 4,464 quintal of stock, and they sold it at an average rate which was varying from 775 rupees to 3,670. Then they also, the audit report also established that the counterparties to which these assets were sold or the stock was sold were actually having cancelled GST numbers or did not even exist at those addresses. The transactions were done in a very short period, and that and how the total amount was about 17 crores, which was kind of brought to the attention. So this is how, and NCLAT also confirmed the NCLT order. So this is how this became, this is a very good judgment where information was complete. It was established that how undervalued sale has happened, and even if it was done through sale of stock, it was recorded as undervalued transaction.
The other principle which is emerging from a judgment, that is Radico Trading Limited versus Varun Batra, the insolvency professional. This judgment is dated 22nd of March 2022. So in this judgment, one principle is actually appearing. It is emerging. Asset of the corporate debtor was sold at a very, very low price, and that was a few weeks before the insolvency commencement date. Directors who actually sold this asset were also under the information that this company is going for insolvency. Buyer, in fact, he argued that he is a victim of this transaction. So why he is actually being made party to this? So the bench, in fact, very clearly held, since this transaction is undervalued, it is massively undervalued. Promoters knew that the company is going to go for insolvency. You are the beneficiary because you have taken an asset which is grossly undervalued. So you can't argue that you are a victim of this transaction. So the look back period was considered, the undervaluation was considered, the knowledge of the promoters were considered. It was not a transaction which is in ordinary course of business because it was a fixed asset of the company, and therefore it is not possible that the buyer of the asset is a victim. Even the plant and machinery, the book value was 1.56. However, the 1.56 crore which was sold for 21 lakhs, and therefore the NCLT said the timing of the transaction showed that the directors deliberately entered into the sale with knowledge of imminent insolvency. The transaction was intended to defraud creditors by placing assets beyond their reach. And therefore, according to NCLT declared the transaction as undervalued and fraudulent under section 49 and under section 45, cancelled the sale of the plant and machinery, directed that the possession of may be handed back to the resolution professional, and held that the suspended directors personally liable to refund and compensate to the resolution estate. Now, the decision of the NCL80, this person went to NCL80, and NCLT also dismissed the appeal, and it was held that there was an argument from the other party that no valuation was done by the RP or the liquidator. So therefore, the NCL80 said that this valuation is valuation or getting an independent valuation expert is not mandatory, it is discretionary. In case there are other evidences acceptable, the documents which actually says that the transaction is undervalued, so therefore then appointment of independent valuation expert is only discretionary. And NCL80 said that the beneficiary of the undervalued transactions cannot claim protection as a victim under section 49. Knowledge of the pending insolvency application and the proximity of the transaction to CIRP supported the inference of intent to defraud the creditors. Tribunal clarified that the code does not protect purchasers who participate in transactions that strip value from the corporate debtor on the eve of insolvency. Consequently, the appeal was dismissed.
In an NCLT Mumbai judgment, which is very recent, 17th of October 25, where the matter is Orion Resolution and Turnaround Private Limited versus Rudolph Anthony. The matter was that the corporate debtor, which was Marshall Breeders Private Limited, the corporate debtor sold shares of a company which were holding immovable properties to the relatives or the daughters of the promoter. And that is what NCLT in this case ordered for reversal, where it said that no, this you have undervalued or you have sold the shares of the companies which are having a very high value or high investment value assets, and you have sold it for peanuts within the look back period. So in this case, 100% shareholding which was held by two subsidiaries of the corporate debtor, that having valuable freehold land, it was transferred at rupees 0.01 and for one shares and 0.10 rupee 10 paisa per share for the other one. So they reversed that transaction, and this is how this was also taken care of by NCLT Mumbai.
See, a very recent judgment on 6th of November 2025, it is from NCLT Ahmedabad bench. Not that I am completely convinced about this judgment. However, I will just present it before my audience. In this case, the transaction alleged to be undervalued are still under investigation, and no final determination has been made under section 45. The resolution professional cannot place a resolution plan for approval that seeks to neutralize or compromise such transactions without first adjudicating them, as this would prejudice the rights of creditors and defeat the avoidance framework under the code. My understanding is that in case the resolution plan and even the application for approval of resolution plan clarifies that if there would be any recovery from the avoidance transactions, that recovery will go to creditors, then this kind of order would not have been passed, because even the regulations clarify now that the resolution plans can be approved by committee of creditors and by adjudicating authority, even if all applications or some applications under section 43, 45, 49, 50 or 66 are still pending. However, it has to be clarified in the resolution plan that how these applications will be dealt with, who will pursue, and in case there is any recovery, then who would be entitled to that recovery and in what ratio. So in this particular case, the resolution professional may not have done this. So the resolution plan was submitted to NCLT while the undervalued transaction, which was significantly higher, was also pending at an investigation stage. So this is possible in many cases. Possible in many cases means there are many cases where the avoidance transaction applications even are submitted during liquidation process. However, the resolutions are very clear, and the RFRP can be very clear that any proceeds out of avoidance transactions would not go to successful resolution applicant, and it would go to creditors. So that precaution was not taken by the RP. So this was the result. So therefore the resolution professional, in fact, identified a transaction involving promoters, related parties, which were prima facie considered vulnerable under Section 45. So the application was also stated to be under consideration. Meanwhile, the RP also approved the resolution plan was also approved by the Committee of Creditors. The NCLT Ahmedabad, in fact, held that the potential undervalued transactions continue to form part of the asset pool of the corporate debtor unless set aside through adjudication. Approval of a resolution plan without concluding Section 45 proceedings would indirectly legitimize value erosion. That's what I said. This is not something which is possible because of various amendments in the regulations, that the RP can put it in the RFRP, that the resolution plan would not claim the avoidance transaction proceeds, and also the RP should have informed or resolved through the COC meetings that who will pursue, who will bear the cost, and who will get the benefit of any proceeds from the avoidance transaction.
But I think there are subsequent amendments here which kind of very clearly say that the proceeds from avoidance transactions cannot be part of the resolution plan unless and until it is disclosed in the IM. So that is basically to circumvent the idea that the transactions are not known to everyone and still somebody talks about that. Yeah. Moving on to the next one, that is NCLT New Delhi Code 2 in Subhash Kumar Kundra RP versus Shiv Seth. How the job work that is carried on by the CD, it is also an asset of the company because the CD was doing job work in this case, and the RP discovered that the proceeds or the profit from the job work or the job work fee was actually coming to the individual account of the promoters or the directors. So he filed an application saying that this job work is happening and the job work money was not coming to the company. The job work was actually being done using company's assets. So the job work related money should come to the company. So that is where the NCLT passed an order, and this was against Classic Bottle Caps Private Limited. And the RP noticed that the plant of the CD was continuing to operate with nearly 70 workmen working at the site. And in this case, the total job work revenue of 69.93 was ordered to be given back to the company, given back to the CD along with 12% interest. So this is how the NCLT directed that this, along with 10% interest, this is how the NCLT directed this money, that money is also part of the assets of the company and this money should come back to the company.
Another principle which is emerging from a judgment, that is Prey Projects Private Limited versus Rajendra Kumar Girdhar, that was dated 3rd of March 2023. So in this, it's a real estate case, real estate company, and the rights were being created by the promoters before the insolvency commencement date. And those rights, although there was a consideration, and the consideration in fact came to the bank account of the corporate debtor, 5 crores in one case and this 1 crore in another case, but on the same day that the entire amount was transferred to other sister concern or associate concerns of the same corporate debtor. So there no, in fact, no value was retained in the corporate debtor, and therefore it was considered that the rights, those are being transferred under these option agreements, real estate agreements. Those are not the transactions which are in the regular course of business. So therefore, these transactions were with intent, which is fraudulent, and it was only an effort to diminish the pool of assets of the corporate debtor, and it was only to circumvent or only to defraud the creditors. Now, it was a case of Mayur Punk Properties Private Limited, a real estate company, and it is only a week before the insolvency commencement date that two option agreements were executed by the corporate debtor. Option agreement 1 against payment of 5 crores, granting an irrevocable option to purchase built-up area in the project, and the consideration was 5 crores. Another option agreement 2 was with a Fervent Securities Private Limited against payment of rupees 1 crore, granting a similar option. So basically, built-up area was given to another person as kind of irrevocable option. So that's a third-party rights, third-party interest was being created in the assets of the corporate debtor, and immediately when this money came, immediately this money was transferred to other associates and sister concerns, and the money of 5 crores and 1 crore didn't stay in the company. And the company, in fact, the CIRP started. So the NCLT bench Mumbai very rightly said that these option agreements are not binding on the corporate debtor, because these rights are being created against a consideration, and that consideration also is not staying with the corporate debtor. So these are the option agreements, the option which is given, these are not in fact enforceable, these are not valid. So the third party rights which was being created, those were in fact considered as void and invalid. And this NCL 80 also upheld the order very clearly that the consideration received will be considered as nil. So therefore, the value of these rights was considered as nil by NCLAT, and it was considered that the option agreements artificially depleted the asset base of the corporate debtor and squarely fell within section 45 and 46. Now here these are some of the transactions which are accepted as transactions under section 45. At this moment, before I shift to the transactions which are not accepted as undervalued transactions, I would like to say that there are amendments which are proposed in the IBC Amendment Bill 2025. So one, that the relevant period for avoidance transactions overall, in fact, it has been shifted from insolvency commencement date to the date on which the application was submitted. So all that time that actually is spent on the adjudication, maybe it's a year or 6 months or 2 years, that is now also covered in the look back period. So in case the proceedings before NCLT is taken 1 year, so then the look back period for related party would be 3 years, and look back period for unrelated party would be for 2 years. So that is what is the proposed amendment in the amendment bill, and also the relevant period for undervalued transaction is also same. That is also clear. But then the name of the transactions, like avoidance transaction as undervalued transaction, that is also proposed to change, and now it would be called avoiding a transaction at undervalue. That is what is the name they have given to undervalued transaction, avoiding a transaction at undervalue. And also as now these applications can be filed by the creditors individually or jointly, and also the members or partners of the corporate debtor are now empowered to directly apply to the adjudicating authority for avoidance of transactions. Now they can file an application under section 43. Earlier it was only for 45. Also for 45 now, section 50 and 66. Now the creditors, members or even the partners can file all these avoidance transactions. That is where the entire the process is not now restricted to the wisdom of RP. So anyone can now apply their wisdom and inform the transaction to the adjudicating authority. And in case such an order is received, such an order is passed, then of course the RP would be under scrutiny for why this is not, why the RP or the liquidator has not taken the appropriate steps, why the RP or the liquidator has not reported these transactions.
Next, there is a principle which emerges from a matter called Aaj Ka Anand Publications LLP versus Vinita Maheshwari. It is a very, very recent judgment, as recent as 19th of December 2025, and just 3 days back. However, it is something where NCLT did not give the order and did not give section 45, or rather sanctions section 45. And the pleading that was taken up, and because of which this did not happen, was that the pleading that liquidator or RP talked about was that the CD transferred assets or undertook a transaction for a consideration significantly less than the value provided. Then such transactions fall within the look-back period, and transactions are not an ordinary course of business. And in the absence of specific pleadings, which NCLT recorded, said that valuation material is not available. You're saying that this was sold at this value, but you're saying that this was undervalued. You're not substantiating that how it was undervalued. You're not giving a valuation report that what was the value of this asset and what was it sold for and how it was undervalued, and quantifying those amounts. So that's what the court said is not leading to a clear determination on section 45, and therefore consequential reliefs were also not granted. So transaction test was talked about here. So the transaction to fall within section 45, the following must coexist. What all should coexist? The one, the CD must have transferred assets or incurred obligation for consideration significantly less than their value during the relevant look-back period. And then it said that the nature of undervaluation should be specifically pleaded by the RP. The comparative value should be specifically pleaded. Date of transaction should be talked about. Applicability of section 46 should be justified. And to seek then relevant reliefs under section 45 to 49 with respect to the undervalued transactions. So here the transaction was mostly leave and license agreements, that certain leave and license agreements were done, and it was contested by the RP that, see, this leave and license agreement has resulted into a lesser rental income for the company, and this way the value has been reduced. Then deed of usage, under which business operations, assets and goodwills were allowed to be used by this. So effectively the LLP, the entity, the company had given its operations away in form of a lease deed, in form of a leave and license agreement, and in the form of deed of usage, that is, somebody can use all his assets for some amount of money. So although the RP here, the NCLT here did cancel all these agreements and granted restoration type reliefs, but while doing so, the the NCLT referred broadly to the undervaluation, but did not record a clear independent finding with respect to section 45, where it would have said that this is the quantum of the value that has been taken away from the company, and this is what needs to be restored to the company. So that did not happen. However, these contracts were struck off.
Another principle which emerged out of a judgment dated 25th of January 2024 in the name of Gloucester Cables Limited versus Fort Gloucester Industries Limited. In this judgment, principle which actually is emerging, that the undervalued transactions under the IBC cannot be presumed or declared suo motu by the adjudicating authority. They must strictly arise from a statutory avoidance application filed by the resolution professional, based on a complete and operative transfer that has actually depleted the asset pool of the corporate debt. Now, this is a case where the dispute arises that the trademark and the brand asset of the corporate debtor that was somehow alleged transfer or assignment to another party, and it was claimed to have a substantial value. The transaction was actually not an outright sale or completed transfer, but arose from contractual arrangement with contingent clauses whose operation depends on fulfillment of conditions that never fructified. Corporate debtor, before the insolvency commencement date, and entered into an agreement with a probably a related party or even unrelated party, where the assignment of the rights were given to somebody with some contingent clauses, and that never fructified. Now, at the time of agreement was executed, the corporate debtor was in fact under BIFR, a related statutory state, and no, there was no material on record to show that the trademark had in fact been transferred, alienated, or removed from the corporate debtor's estate in a legally enforceable manner. No avoidance application under Section 45, 43, or Section 66 was filed by the RP seeking to challenge the transaction as undervalued despite this. So, one, there was an agreement for assignment of trademark which was not fructified because of certain conditions. That agreement was in fact signed during that company was under BIFR. RP in fact immediately started challenging, and without even the conclusion, without forming an opinion. So the bench, the adjudicating authority, in fact said that such an exercise was impermissible, as the adjudicating authority cannot suo motu declare a transaction to be undervalued in the absence of statutory application by the RP. The tribunal emphasized that the avoidance proceedings are not matter of equity or perception, but are governed by strict statutory trigger, timeline, and procedural safeguards. Since the transaction was incomplete, contingent, legally constrained, and not challenged through the prescribed mechanism, it could not be treated as undervalued transactions under IBC. So this principle, in fact, was something which actually a precedence which can be used, that the adjudicating authority does not have a suo motu power to declare a transaction as undervalued without the application, proper application, without looking at the look back period, and without even understanding whether the transaction was actually implemented or not, and also when there is no asset of the company was transferred in favor of a third party, there cannot be considered as an undervalued transaction.
In an NCLAT judgment, which is Avni Jain versus Manoj Kulshrestha, which is dated 23rd of April 2025, an interesting observation was made by the NCLAT, although I think that it's pretty much understandable that when we look at these undervalued transactions, we are primarily looking at transactions that have happened prior to the CRP date. But in this case, the RP filed an application under section reporting transactions in the look back period under section 46 and said that he claimed to have claimed that the transactions have occurred on the CRP commencement date and filed this application under section, talking about how the period is under section 46. And that's where the NCLAT clarified and said that you can't use this provision for, you can only use this provision for prior to the CRP date. If there is any transaction that has happened on the CRP date or after, then that is rather a violation of the moratorium under section 14, and the application should talk about how the moratorium has been violated by the directors or the promoters in doing any transaction which resulted into the company, the corporate debtor resulting into loss of assets. So that's where this differentiation was created, and basically that's where all these transactions, so the RP's reply highlighted, it showed that that booking amount was required at booking and to be paid into designated UP RERA accounts, but these amounts were actually credited prior to the on the CRP date to a different account. So because they were post CRP, it was very clearly said that no, this is not transaction under section 45, and this would rather be a problem with respect to the moratorium.
Sarla Performance Fiber Limited versus Vivek Murlidhar Dabade, a judgment dated 24th April 2025. This also, I'm not convinced about this judgment where the undervalued transaction has been rejected by the adjudicating authority. In fact, only a few weeks before, the application was filed for the insolvency of a company, the entire land and building and 1000 square yard of plot, all plant and machinery, everything was given on a rent for 5,000 rupees per month, and that rent agreement was for 12 years. So this was also rejected as a undervalued transaction, and I will come the reasons, but like I feel that it could have been argued better, and the facts must have been presented in a better manner, because according to my understanding, any facility which is given to a person at 5,000 rupees rent, whereas the like transferring somebody the rights of usage of a particular facility, even if there is the contractual right, this is a contract that has been given to a particular person, the third party rights have been created. So I think the proper argument was not done, because the third party rights have been created in the asset of the company, that is for 12 years, only for 5,000 rupees rent per month. The court has actually said that the leave and license agreement, even if commercially unprofitable or entered into at a low rent, does not constitute an undervalued transaction under section 45 of the IBC unless it involves the transfer of value by the corporate debtor for a consideration significantly less than the value provided by it. Mere inadequacy of rent or commercial imprudence cannot substitute the statutory requirement of section 45. The corporate debtor in this case, Desimran Cartoons Private Limited, owned an industrial land measuring 1000 square meter along with the factory premises at Dadra and Nagar Haveli. Application was filed by someone in May 2019, placing the corporate debtor under financial stress. After the application was filed by the bank, within 1 month of the application, during the financial distress, the corporate debtor entered into a leave and license agreement with Sarla Performance Fiber Limited for a period of 12 years at a monthly rent of 5,000. And then thereafter, the CIRP commenced, and upon failure to resolution, the corporate debtor was ordered into liquidation, and the liquidator filed the application for section 45, seeking to classify the leave and license agreement as undervalued transaction. The NCLT Bombay held that the leave and license agreement, they wanted to examine whether it satisfies section 45 ingredients and conditions or not. The adjudicating authority held that section 45 was not applicable and rejected the prayer seeking classification of the transaction as undervalued and consequential relief under section 48. It held that section 45 contemplates a transfer of asset or value, whereas the leave and license agreement merely permits the use of the premises, but whereas my understanding it that creating a third party rights also prohibited under section 45, third party rights in the assets of the company. Assets of the company is being given to someone at 5,000 rupees per month rent for 12 years. So this is akin to sale. It is akin to creating third party rights. So therefore, even NCLT also upheld this particular order, says that as far as section 45 is concerned, NCLT said that it is not applicable. What else can be considered as creating third party rights in the assets of the corporate debtor?
In the other judgment where we're talking about Aj Ka Anand, There also the application under Section 45 was declined. However, there also the leave and license agreement and such agreements which had a negative or subordinate interest were created to reduce the value of the company were struck down. So I believe that 45 is being differentiated. That 45 is basically talking about how the lost asset value can be restored to the company from either terminating contracts or bringing back that value that has gone outside the company or outside the CD. Whereas with respect to leasing rights or wherever a leave and license is created, lease is created, restoring or other deleting those lease arrangements, I believe is not being taken care of under Section 45 as of now.
In the meantime, we also have seen the judgment where the option 1 and option 2 with third party rights was being created and the consideration is received, but the consideration is transferred to other concerns. But that was also creation of third party rights in the assets of the company. Creating third party rights does not mean it's a transfer of asset, it is sale of asset. It was only third party rights. Similarly, giving something on a long lease for 12 years at just a small amount of 5,000 rupees per month, these are also third party rights for a lower consideration. So, according to my understanding of Section 45, this is a transaction which covers the ingredients of Section 45.
In another case, which is an NCLAT judgment, Jagdish Kumar Parulkar, liquidator of Kapil Steels Limited versus Indore Steel and Alloys Private Limited. It's an NCLAT judgment dated 21st of March 2023. In this case, Section 45 read with Section 49 it was held that it can be invoked only where the CD has transferred an asset or interest which legally vests in it. So for a consideration significantly lower than the realizable value. So in this case, the CD had a land which was originally leased by MPIDCL to the company, and then it was mortgaged to MPFC, and due to the default, the land allotment and the lease was cancelled by MPIDCL. So as on the CRP commencement date, this corporate debtor did not have the valid lease to that land. And then with respect to the shed, even the shed was something where the PTL, that was the financer, that was Power Age Tars Limited, had also the suspended management of the CD had sold a tin shed to this company, and this company had also sold it to the Indore Steel and Alloys Private Limited separately. Side by side, MPIDCL had allotted the land which it had cancelled. Lease was cancelled. MPIDCL allotted that land to Indore Steel and Alloys Private Limited. So effectively, what happened was CD's asset, which was the land and the building, was indirectly the building was transferred, and also the lease was cancelled, and the fresh lease was executed with this company by MPIDCL directly. In this case, of course, it was attempted that Section 45 order can be received and the original assets of this company can be restored. But the NCLT said that you cannot restore what was not belonging to the CD initially. So the CD did not have this right in itself, and the rights in itself were cancelled, the leasehold rights of this land. Then you cannot really restore that right, which was not even belonging to the company. So only that can be restored, or that asset can be restored that belonged to the CD.
On 9th May 2023, NCL 80 has also held a unique principle, that is in the case of Arun Chadda versus Ramesh Kumar Suneja. Now, in this case, the huge amount, like 10 crores, were given to related parties as interest-free loan. While this loan has been given to the related parties as interest-free during the look-back period, in the meantime, the company, the corporate debtor, is paying interest to banks. This was also rejected by the adjudicating authority on the principle no transfer of asset was found in this case. Also, the amount which is given to the related parties is shown as recoverable in the books of account. Mere loss of personal interest does not amount to undervaluation within the meaning of Section 45. Company, in fact, originally it was into resolution process, then it went to the liquidation, and the total advances aggregated to 10.23 was given to 4 related parties, including the other. The applicant contended that the corporate debtor itself was borrowing funds on interest from banks. Advancing monies without charging interest resulted in a notional loss, which was computed by the RP or the liquidator at 12% per annum, and sought recovery of both principal and notional interest by treating the transaction as undervalued under Section 45. Now, NCLT Mumbai held that interest-free loans and advances satisfied the statutory ingredients of Section 45. They started examining this. Tribunal held that Section 45 applies only where there is a transfer of asset or value of the corporate debtor for a consideration significantly less than the value provided by it. So in this particular case, one thing unique which actually was held by NCL 80 in fact upheld the judgment, and basically with the same principle that no asset has been transferred, and the assets are still appearing as recoverable, but a liberty was granted. A liberty was granted to the applicant, the RP or the liquidator, that the conduct and the transaction can be examined under Section 66 for fraudulent trading, leaving the avoidance jurisprudence under Section 45 untouched. So, Section 45 is not invoked, it cannot be invoked for notional loss of interest, transfer of interest paid money to related parties. Principal is also outstanding, no interest is being charged. So that can be still examined for Section 66, as the intent of these transactions seems like fraudulent. So this is a good and clear decision that in case a transaction is not getting covered in one, the liberty is granted to get it examined in another section, that is Section 66.
In Ritesh R. Mahajan versus Ranjit Baban Rao Shinde, which is again a recent judgment, 12th of September 2025, what happened in this one is that undervalued transaction under Section 45 was not granted by NCLT because the application that was filed by the RP merely said that the transfer of assets has happened at less than the WDV in the books of accounts. So NCLT in this case said that you have to get a valuation done of those assets. You have to determine the value in some other way, because the NCLT said that simply saying that written down value is a benchmark for how much value should have received from the sale of that asset is not a good enough idea. It is possible for somebody to sell these assets at less than WDV, and that might be the market value of those assets. So the market value, the WDV, cannot be understood to be the market value of that asset. So here 40.57 lakhs was the WDV of the asset, whereas the tankers which were available with the CD were sold for 30 lakhs plus GST. So this is where the NCLT said that we need more details as to what is the market value to pass a judgment that this was indeed undervalued.
So we have now covered many transactions which are accepted as undervalued transactions, and we have also deliberated on many transactions which has been adjudged by adjudicating authority and appellate authority as transactions not acceptable as undervalued transactions. In some of the cases, the adjudicating authority and the appellate authority has given the liberty to examine this transaction in other sections like Section 66. What we have seen, the primary ingredient in Section 45, that there must be a transfer of asset or a gift of an asset of the corporate debtor to a third party. So that is the most important part in the Section 45. So in case the court is not finding any asset being transferred, may it be a trademark, may it be a possession of the assets on lease, or leave and license agreement, the adjudicating authority is not satisfied the applicability of section 45. However, such transactions can be covered, can be examined for section 66. This involves transfer, but my understanding is that it can actually be argued like in case the third party rights are created on the all assets of the company at merely 5,000 rupees, and that too for 12 years, it actually tantamounts to transfer. It is akin to transfer. So therefore, these kind of transactions may be covered under section 45. So that's what is the analysis today.
Yes, I believe, yes, we have looked into section 45 and a lot of things, that how we need to be careful about establishing how the transaction is undervalued. We can't depend on WDV. We have to give very, very clear numbers to NCLT along with dates, along with when the transaction happened and how it falls under the section.
So even if when we see the section 48 subsection 1 clause C, we find that the adjudicating authority also has a right to pass an order where the adjudicating authority can require any person to pay such sum in respect of benefits received by such person to the liquidator or the resolution professional. So such sums can be the adjudicating authority can ask that person who has taken the leave and license agreement that the benefit that he has taken that can be ordered to be transferred to the RP or the liquidator. That is what is provided in section 48 subsection 1 clause C. So what I'm saying, that benefit of that very, very peanut as rent and agreement for 12 years, that is a benefit that has actually been transferred to another person. That is also covered under section 48(1)(c). So therefore, we can conclude this session as section 45 is very important in case we, as insolvency professionals, in case we don't report such transactions, anyone can report it, and then we have to face disciplinary action. So be careful, and we as AAA Insolvency, and we are here to help in case of any question, reach out to us. Thank you.